Hello everyone, welcome to Best of Us Investors. We as a tribe are gathering in the Discord server, where we share Carrie's portfolio, Carrie's buy and sells in real time, and we have live discussions every Mondays before the market opens and right after the market closes on Fridays in our voice channels in the Discord server. And of course, we share insights on stocks before the videos are released. The stock analysis team also analyzes stocks based on the votes from the tribe members. So hope to see you all in the Discord, where the link is listed in the description to join. We would also appreciate if you can subscribe and hit the like button, which will help our stock analysis videos. Now let's get started with our stock for this week. Today we'll be talking about Affirm Holdings. The ticker symbol is AFRM. Affirm operates a platform for digital payment where you could buy now and pay later, spreading out the payment for several months, if not years, in the US and Canada. So they focus on payment solutions for customers, merchant commerce solutions, and consumer-focused apps. And as of September 30, 2020, the company had approximately 6,500 merchants integrated on its platform and about 6.2 million customers. To explain a bit more on what they are trying to do, Affirm's main goal is to replace the credit card industry and revolutionize the sector. So instead of having to pay off your credit card that month with a high interest rate of approximately 20 to 30%, Affirm gives you the option to select whenever you want to pay the amount off within 3 months, 6 months, or even a year and more, with a much lower rate of interest without any fees or additional payments, which will actually save you all that interest fees compared to the traditional credit cards. Affirm has value for both the customers and the merchants. Affirm is customer friendly, where it's very easy to use, straightforward regarding the payments, and has no hidden or additional fees. So since customers can buy now and pay later, spreading out the period of the payment, there's a high possibility that this would enable customers to afford things that they might not have been able to purchase in the past using their credit cards. Of course, the longer the duration for the payment is, the more interest you're going to pay, which totally makes sense. But it is nowhere near the percentage that the traditional credit card is asking for, which is approximately, again, between 20 to 30 APR, annual percent rate. Affirm is again trying to revolutionize the sector of digital payments, mainly by trying to help avoid unhealthy debt. What is unhealthy debt? In the traditional credit card industry, you get charged an APR of 20 to 30%, and more worse, this compounds. So if you are not able to pay off that month, you will get additional debt based on the interest rate, which then will cause a compounding effect, and the debt that you have to pay will grow over time. And that is a very, very unhealthy financial situation. With the firm, the amount that you owe is not going to change whatsoever, and it has no late fees or any compounding interests. If by any chance you miss the timeline that you selected to pay, you won't pay a fee, but this will be on record, and for your future purchases, you will not get the same optimal offer. So they're basically saying, look, we're giving you a great deal relative to credit cards where you don't have unhealthy debt that is going to compound, but you need to stick to the rules of making your payment during the period that you selected. Now, for the merchants, Affirm is also a great method, since this payment option will translate into more sales, since they can now spread out their payment, meaning paying less every month with no interest, which will increase the order volume and also more repeated use from customers. So having Affirm as an option increased more than 85% in their average order value, because customers might have felt more comfortable spreading out their payment and therefore buying products that they would not have paid in the past. And also they saw approximately 20% repeat purchase rate, with Affirm building a loyal customer base, which is also another amazing benefit for the merchants. Another key element that merchants like about Affirm is that it enables them to build up their brand without discounts or promotions that may hurt their brand value. So instead of giving the customers a promotion or discount, making the product actually more cheap, they would spread out the same amount needed to be paid, making it more affordable without changing the price of their brand product. Affirm also has an app that has great reviews where you can see the products available to be paid with Affirm payment options. So in other words, a one place to see products that have deals with Affirm. You also can get an Affirm card, pretty much like a credit card, where you can bring it to the shop, and if you want, you could pay the total cost up front or buy now and pay later. Affirm also has a high yield saving account that was recently launched and is attracting a lot of customers. Now, if you look at the NPS value, the Net Promoter Score, which basically means the percentage that the users would recommend this product, it was 78 after Tesla and Apple, which was 97 and 89, and higher than Disney or Visa, which was only 50 and especially 8 for Visa. So this is a really important factor when it comes to spreading your sales and marketing. Now, the amount of transactions or the merchandise volume that's going through their platform each year has had exponential growth from a couple $1,000,000 to 4.6 billion, where there was a 77% growth from 2019 to 2020. Based on Allied Market Research, the global market was valued at 90.69 billion in 2020 and is projected to reach 3.98 trillion by 2030. So they are going after a huge market that is growing really, really fast. They have also announced that the next frontier at Affirm is the unbundling of daily spent, such as groceries, restaurants, and incidental purchases, which in my opinion will be huge for this company. So for instance, you go to a fancy restaurant and pay $360 for a meal, you could spread out that for 12 months, only paying $30 a month, which might be much more affordable for a lot of people. As we may all know, the stock price has gone up a lot due to their partnership with Amazon, which I think might be insane, since the holiday seasons are coming and the demand for e-commerce, especially on Amazon, is high, and think it will only get higher with the option from Affirm. So to me, it seems like it may be a cheap way to get on the growth of Amazon without purchasing Amazon stocks that are over $3,000. So personally, I do not have any stocks, but will definitely keep an eye on how this company performs. And especially after a run-up like the one that they just had, I would wait for a pullback if you were planning to buy some shares.
Now, Affirm has a list of competitors. For now, I'll be looking at and comparing them to Afterpay, their most popular competitor, ticker APT, Sezzle, ticker SZL, and OpenPay, ticker OPY. All companies which offer a buy now, pay later service with sometimes zero interest, sometimes more. In general, just less interest than what a credit card would offer. Somehow, all these competitors of them seem to be Australian based, with Affirm being the only one originating from the US. The financials might contain some mistakes since I had to convert them from Australian dollars to US dollars manually. Let's start off with revenue. Affirm currently has the most revenue. If these financials are correct, they also have the largest market cap. Price to sales ratio is big, but not as big as that of their competition like Afterpay. Amazon will soon start providing users the option to pay with Affirm for orders worth $50 or more. Amazon being the biggest name in e-commerce, will this probably cause Affirm's revenue to rocket up, especially with the holidays being just around the corner. Regarding profitability, Affirm, together with all their competition listed here, aren't profitable or anywhere near profitable. A thing to look at then is their cash amount to see how long they can keep this up without having to do something like another share offering to raise cash. Affirm by far holds the biggest cash position with about 1.5 billion worth of cash and cash equivalents. And secondly, you have Afterpay with 835 million, then Sezzle with 61 million, and OpenPay with 33. And looking at how these companies have grown their revenue year over year, Affirm grew their revenue with 70% year over year from Q2 to 2021. Afterpay with 70%, Sezzle with 159%, and OpenPay with 99%. Would I buy Affirm at this price? Well, no, not at this price. I'd wait for a dip first. However, I do see Affirm as an interesting buy, since with them partnering up with Amazon, they are bound to increase revenue in huge amounts. It hasn't been seen before, a service like this partnering up with Amazon, so it could provide some great results.
So I'm going to go with the partnerships first. Pretty obvious. First partnership I'm going to mention is with Amazon, which has caused it to run up more than 100%. Consumers on Amazon who pay more than $50 for a purchase can have an option to use Affirm's buy now, pay later concept to pay later on their purchases. So if Affirm even captures around 1% of Amazon sales through this partnership, they could add 900 million to their revenue. So with this partnership, that's why people have been really buying the stock. Affirm also had a partnership with Catapult, which is ticker symbol KPLT, and that stock has also had a great run up because of Affirm's partnership with Amazon, which caused KPLT to also go up 100%. With this partnership, KPLT gives company access to customers who were rejected for leasing options, and Affirm sends that data Catapult, who can offer approval to the customer. So they're kind of working on the back end of what Affirm is doing to like handle these customers and the data. Just like Amazon, Affirm has partnered with many of these other businesses like Peloton, Shopify. A lot of companies are using their buy now, pay later system with these partnerships, which could result in Affirm to have a good run up if they do get the revenue from the sales, just like with Amazon. And Affirm also has a partnership with StubHub, which is a ticket resale company, and it's also using Affirm's buy now pay later system. There's just many of these companies that are using Affirm's buy now pay later system through these partnerships, just like with Amazon. So these are main partnerships that Affirm has going on right now with other companies that are using their finance system. Looking at the cons, if you look at the PS ratio for Affirm, reasonably high at 40. It is a growth company, so that could be expected, but it is pretty high if you're looking for something more like a value play or anything like that. This is definitely not it. On the technicals, the MACD is turned all the way to the top on the daily and 4-hour chart, and it's looking like it can curl back down. So I almost 100% expect to move downwards from this point. The other thing is that the RSI is close to overbought at around 67. So with the MACD at really high levels, the RSI really high, with two gaps that it could potentially fill, I think the stock is ready to take a downturn. So definitely not a point to get in right now for me. And the operating expense is pretty high for the company at around 867 million, which is overtaking their gross profit, which is 540 million, which is causing it to have a operating income of negative 326 million, which is making it a non-profitable company. Yeah, so with all these cons on their technicals and fundamentals, I'm not really looking to get in the company right now and could be expecting a downturn from now on. So yeah.
Okay, so today we're going to look at the financials of Affirm. They just recently IPO'd in January of 2021. So the data is limited. Currently, as of this video, share price is about $116.28. 52-week low is $46.50. $146.90 has been the high. So very volatile stock, up and down. They just had an earnings report that came out in September, so I didn't have the 10Q at the point of time I was looking at this. So I'm just going to go back to the March 10Q of 2021, and we'll look at what's been happening here. So the total revenue has risen in 9 months ending March 31st, 2020, 356.1 million, went up to 608.6 million in 2021 of March. That's good. Revenue is growing. Then that's kind of where the good news ends for me. Go down and look at the total operating expense. You can see from 503.3 million to 838.2 million. So you take the total operating expense from the total revenue, and you can see that the operating loss is about 229.5 million as opposed to 147.1 million from the 9 months preceding from a year ago. So the net loss ends up being 277.7 million versus 147.4 million from the 9 months ending in 2020. Net loss per share in the recent 9 months was $2.48 compared to $3.35. And you might think, wow, that looks working better. But until you go down and see the weighted average common shares outstanding, they went from 47.9 million as of March 31st, 2020 to 123.3 million shares. So they over doubled their shares basically because of the IPO. And so that causes your loss per share to be reduced. So we go onto the balance sheet, and they have about $1.6 billion as of March 31st, 2021 in cash and cash equivalents. So that's a good thing that they have cash. Their current assets exceed their current liabilities. So that is also good. But you can see down, basically, they had notes issued by securitizing trust. And also that was 1.2 million. And then funding debt was 768 million. So that's on their long-term debts. Moving on to their cash flow. We start with their net loss, 2021. It's 277.7 million. And as we go down and we see net cash used in operating activities, and operating activities is the business itself and how much money it generates, a loss of $173.2 million. So they're not getting cash from their operations as of yet. We go down and look at their investing activities. You can see $1.1 billion of negative investing activities. So they're not getting the cash from the investing activities. And as you can imagine with an IPO, we go down to cash flow from financing activities. You can see that this is where their cash is coming from. Proceeds from funding debt, 2.4 billion. Proceeds from issuing of notes and residual trust certificates, 1.3 billion. proceeds from issuance of redeemable convertible preferred stock, $434 million, and proceeds from the initial public offering of $1.3 billion. So net cash provided by financing activities as of March 31st, 2021 is $2.7 billion. So again, it's an IPO. They're not making any money. They don't look like they're going to make any money in the next 3 years, according to Seeking Alpha. And that's just the way a lot of these growth companies go. Total revenues for 2021 were $870.5 million, which was a 71% increase over 2020. So it's good that revenues are increasing. However, when we look at operating losses, we have $379.2 million in operating losses versus 107.8 million in 2020. Now, this loss includes 258 million in stock-based compensation. So again, the owners, shareholders who were before the retail investors, employees, executives, directors, all have their hand in the till before, as an investor, will probably ever see money out of this company, in my opinion. 64 million in stock warrants, and then their net loss for the year was 430.9 million versus 112.6 million in 2020. So as you can see, they're not making any money. They have a lot of stock-based compensation out there and a lot of stocks in reserve to be issued out as they need more cash. It's been widely recognized by consumer services and reported that consumers using these buy now, pay later services saw their credit scores fall. Well, a third of the people actually using this, according to these services, quickly fall behind on payments. So if the customers are falling behind on payments and in default, that's not going to help your bottom line either. So the company's market cap is $36 billion with a revenue guidance of $1.16 billion. So a lot of people would say you're paying about 31 times sales based on 290 million shares outstanding, and they have millions of shares, stock options still available yet to come out. So that's a negative for me also. With net revenue between 550 and 570 million, stocks trading about 60 times revenue, making it pretty expensive as a stock for me. When we come up in the end, in my financial summary, and I have 8 points that I look at, revenue is increasing, so that's a plus for me. The operating income is negative, which is a negative to me. The net income is negative, which is a negative to me. Per share earnings is a negative. Number of shares is increasing year over year. That's a negative. So they're going to dilute your shares. I feel that they'll probably have to go and issue more shares, which is going to dilute the retail shareholders' value in the stock. The balance sheet does have current assets above current liabilities right now, so that's a positive. Stock-based compensation is sitting out there and it's increasing, 258 million that I just talked about. And liquidity and capital resources. The company has incurred losses since its inception, accumulating deficits of 734 million as of March 31st, 2021. The sources of funding for this company are Series G preferred stock, 435.1 million in October, and then of course the IPO Class A shares, 1.3 billion in January. Right now, they do have 1.6 billion of cash to fund the operation as of March 31st, so they have cash to go forward. But I believe that they're going to have to issue more shares, issue more debt, for this company to move forward. With that said, my motto has always been to invest in companies that make money, not in companies that are losing money. And right now, Affirm is losing money. Not to say it's a bad company, not to say you can't do your due diligence, but it has a lot of momentum swings, and maybe you can swing trading. That it might be something that someone would be interested in. When you look at over the last 18 months, there's been a lot of stimulus money out there. So people have had money, and it would be something to look into, that does this stimulus money get put into these kind of payment systems? And now that the stimulus has gone away, will we still see that money come in? So that's a risk I see out there. Other things that I see are the things that are going on just in the general economy with the Fed. Are they going to taper? Will they not taper? When will they start the taper? Are they going to raise interest rates? Are they not going to raise interest rates? Those are all put uncertainties into the market that we go through almost daily. Then you look at the bond rates, a 10-year bond, 30-year bond rate. The yield goes up, bond price goes down. What does that mean? There's issues there. We're printing money left and right. We're going to do a $3.5 trillion stimulus package that we as a country probably can't afford at this point. Even Kerry has gone out and sold some of his FANG stocks to raise cash in anticipation of the market going down. So with all that, I would not pick this company per se at this particular time, put any money into it, being it doesn't make money, being that the market is the way it is, and that people are basically out calling for the market to correct or to crash based on the S&P 500 going below its 50-day moving average. I was raised in my life not to spend more money than you make and to try to keep out of debt as much as possible other than your mortgage. And so for this company, if I were a customer and I couldn't spend money on a dinner, I wouldn't have dinner. I would save up and have dinner. So if you can't afford it, don't buy it. And that's the same attitude I have for Affirm Holding Company. I would not buy this company at this time.